Welcome to the Bonhoeffer Fund's 2020 annual meeting. The Bonhoeffer Fund is an investment partnership dedicated to finding and investing in undervalued securities that are undiscovered or misunderstood. Unhindered by geographical boundaries, the fund seeks opportunities with underlying benefits such as compound mispricings, miscategorized firms, public LBOs, or corporate actions. Portfolio manager Keith Smith co-launched the fund with Willow Oak Asset Management in 2017. With more than 20 years of experience as a valuation expert, Keith has held positions with Empire Valuation Consultants and PwC, honing his experience in technology firm valuation, corporate transactions, distressed loans, derivatives, and intangible assets. He is a CFA charter holder and received his MBA from UCLA. As a personal investor, Keith applied risk management tools he learned as an Air Force captain and the analytical tools he learned as a valuation expert to identify market inefficiencies and sector disruptions where patient investments return significant results. We are delighted to share the Bonhoeffer Fund's 2020 annual meeting presentation presented by Keith Smith.
Welcome to the Bonhoeffer 2020 investor presentation. We hope you and your family are safe given in this COVID time. This year we're doing our presentation virtually. We wish we could see you in person like we've done in the previous years. It's been a fun time to get together and just to sort of catch up on what's going on with everybody and to review our portfolio and our performance and some of the ideas and the concepts that we're using in investing. My name is Keith Smith. I'm the portfolio manager of the Bonhoeffer Fund. I've been that since the inception, and we have as you can see as we go through this, what we believe is a very unique strategy in terms of trying to capture returns in the market, the market's been challenging, as you know, and we'll sort of go through some of those details as we go through this virtual conference. In the first part of the presentation today, we're going to be reviewing Bonhoeffer's philosophy/approach. This includes describing where we go, how we go, and what we look for in businesses that we invest for the Bonhoeffer Fund. First of all, where we go. Where we go is basically the universe of the countries and the situations that we look at. And that includes countries that have, historically had good governance, and or improving governance in countries that may be transitioning to good governance. Part of this really has to do with how long capitalism has been present in the countries. It's sort of a learned type of activity. And so countries that have had capitalism for long periods of time and have seen prosperity has led to a lot of stability. We also, in terms of the initial screen, we look at places, for example, that have high economic freedom scores, where places like the Heritage Foundation have identified. Those are the initial areas that we look at and what we define as the scope of the geography of businesses we're interested in. The next level is looking for growing businesses that it may have multiple ways for us to win. In regards to that means key aspect of businesses is looking at growth, profitable growth. And one of the two key drivers of that is recurring revenues and velocity. Velocity being how fast a good or service is being sold through to the end consumer or being consumed. The higher the velocity, the better the business is in regards to generating return on capital for a given margin they can charge for a product. The other thing that we look for is unlocking of governance discounts. In many of the situations we get involved with, there's governance discounts in regards to the company being penalized for maybe historic governance that hasn't been the best, but what's actually happened is the governance has gotten better, or there's been incentives in place by the governments and other things to make the companies do the right thing. All of our companies have one of our three frameworks that we describe as compound mispricings, characterized firms, or public LBOs, or special situations, and or hidden options. Many of our firms have multiples of these characteristics. These characteristics are ways where value can be unlocked. We try to identify ones that have multiple characteristics in this way. That way we have multiple ways to win in regards to actions occurring each one of these areas. We'll describe these in more detail later on in the presentation. One thing that we do focus on is firms with good, we would describe as valuation growth profiles. Growth definitely really affects valuation. As a business appraiser, I'm familiar with sort of how that really sort of plays out. So what we try to do is we try to find companies that are growing, whose valuation is less than let's say what the amount should be given the level of interest rates at the particular time. So many of our businesses have modest growth. Some of them have high growth, but even the high growth businesses are available at relatively low valuations. And finally, we try to identify actions or catalysts to unlock value. You can identify a lot of this value, but unless there's catalysts to really move it along, it can lay latent for a long period of time. And so what we've tried to do is in each of our holdings try to identify those catalysts, and what gets us excited or even maybe getting us interested to buy these businesses is a particular catalyst, either an activist in one case where we bought a company, which we'll describe later today in Korea, and or just management execution. A lot of times a change in management isn't enough to create an increase in value, but what's really required is them actually executing in particular plans. And so and some of these may require large investments so that the value goes down temporarily. And those are the kind of situations we look for in general in the Bonhoeffer Fund. The next part of the presentation describes our partnerships. We really appreciate the confidence that all the partners have put in us in regards to investing in the niches that we're endeavoring to invest in, primarily smaller companies and companies that have these various frameworks and ways to unlock value. Currently, we have 27 limited partners. We've got about 20 of them that have put follow-on investments, and we appreciate that. And my family's money represents roughly around 8% of the AUM. Currently, we've got about 11.2 million of AUM. In terms of the breakout, the folks that are actually invested in the Bonhoeffer Fund, we've got a good variety. We've got a very large amount from family offices, one fund of funds, some high net worth individuals, insurance companies, limited liability corporations, and trusts. Our shareholders come from around the world, as you can see in the map to the right there. We've got concentrations in New York, California, Texas, Washington, and also in Canada and Spain. So once again, we do thank all of our investors, and we endeavor to be as open and transparent as we can. And if you have any questions at any time, feel free to give me a call, and myself and our team are available to answer your questions in regards to the fund or any other items that you may have, any questions you may have associated with the fund. In this portion of the presentation, we're going to be describing Bonhoeffer's historical performance from both a long and more recent perspective. If you look at the first graph on the next two charts, you'll see the longer term performance of the strategy. Over time, this strategy has delivered decent results. I've been implementing this since the early 00s. This chart shows the performance since the mid 00s. As you can see, there's been times where the strategy has performed really well. And then the chart to the right shows the performance since inception. Since inception, what has happened is we've had a headwind in regards to small cap value companies. So what the market has been doing is they have been valuing companies with higher growth prospects with higher multiples versus companies with lower growth prospects. Actually, a number of these companies' values have actually gone down despite the growth that's there. And so this is more of a cyclical phenomenon in terms of between value and growth stocks. These cycles can last a long period of time. This current one is probably one of the ones that's lasted a longer period of time, has been as severe based upon various measures out there that's been around even since the 2000 timeframe. Part of the difference in this one, though, is some of the growth companies probably have more stability than they did back then in regards to recurring revenues and some of the drivers of growth. One of the things that we've done from Bonhoeffer's perspective is we have enhanced the implementation of our strategy. We'll talk about that a little later by taking a look at some of these growth drivers, i.e. velocity and recurring revenues, and trying to incorporate those in some of the companies. And it has been incorporated into some of the companies we have that are slower growers, but still have some of these characteristics of some higher growth companies. When the inevitable turn happens, this, I believe, should allow us to sort of add some velocity to the recovery that would happen in terms of value versus growth stocks. And so I'm very optimistic about the future. This period of time reminds me a lot of sort of the late 90s, where there was a lot of removal of money from value to go towards growth. You finally have some of the speculative bubble that sort of happened, in the 1990s with now the Robin Hood investors and the such. So this may be the beginning, but the timing that we really don't know what it is. So one of the things I do want to note again is just sort of, you go back to that initial chart, is the long-term performance of the strategy has been sound in the past. We're in a headwind now for small cap value stocks. You can see to the right, especially international small cap value, which is sort of where we're playing. If you take a look at most of our names are overseas and they're relatively small, and they do have some good value characteristics. And you'll see later in the presentation, we have a slide that sort of illustrates this, and you can sort of see how we compare to small cap value indexes and larger, more broadly based worldwide indexes. The next portion of the presentation is going to describe where we ended up. Where is our focus, and where do we end up as a result of implementing some of the frameworks we described in the first slide, where we talked about where we go. Where's our portfolio going to be? Basically, it's representative of countries where there's either been a long-term implementation or use of free enterprise in combination with democracy in cases, and or countries where the governance is getting better. In those places where capitalism and democracy have mostly been practiced over time, typically those are the places that have the good governance. And then we also have specific situations where we think there's companies that are moving in that direction very quickly, places like Korea that historically may not have had the best governance, but there are some very specific situations there. The government's put up some good incentives, and there's a lot of conglomerates in that area, which I think provided a fruitful area for spin-offs going forward, as a lot of the rationalization happens in more of these conglomerate type companies. You also have areas like South Africa, where basically there's been the new president Ramaphosa. They were originally capitalists with apartheid. Apartheid was moved away. Mandela and his followers have continued that on. With the last president, there was a little backsliding there, but now I think things are going forward in a positive direction in terms of free enterprise there. So that I think is a clear one, and also provides a lot of growth insight into Africa. The Philippines, we did have some exposure there. One of our positions is going to be taken out. The only exposure we have left in the Philippines really has to do with almost a monopoly media company that I think we're going to hold on to just because of the price and sort of what's there. However, the situation in Korea has regressed to a certain extent. So at this point, in terms of new investments, we really haven't been looking there actively at this point. In some of the other countries, Italy and other European countries that basically have decent governance and such like that. One thing you'll notice about the country mix here is a lot of them are probably in places where you wouldn't have exposure in terms of other broad-based funds. So you're getting exposure to countries that are improving relatively rapidly in regards to governance. And a lot of these countries, just their values are on a relative basis are relatively inexpensive, and you expect that to normalize over time. If you take a look at the specific industries that we're invested in, a lot of them have the themes we talked about earlier that are drivers of growth. For example, recurring revenues and velocities. You find recurring revenues in a lot of telecom businesses, data processing businesses, soft drinks businesses from a consumer products perspective. And then the other key themes in terms of some of this industry exposure that we have here is velocity in regards to some of our auto dealers and the distributors in terms of those types of companies. Velocity is very important. And then in addition, we have some that are more along the themes of really trying to capture the infrastructure rebuild in the US, and then the expansion of the renewables infrastructure. That's going to require quite a lot of both equipment, minerals, mining, etc. And what we're really investing in those are more of the picks and shovels in the mining and more capital intensive industries. And so we've got some pretty interesting leasing businesses, I think, that should do really well as this infrastructure is built out and the requirements for these minerals explodes over time. Those are the two areas where we focused in terms of industry and country levels. The next slide talks specifically about some of the portfolio characteristics. And from the slide, you can see how we differ from both the larger, broader index, which is the MSCI without World ex-US index, which is all the way over to the right, the International Small Cap Value sort of index, which is represented by a specific fund that actually implements this on a low-cost basis, and then the Bonhoeffer Fund all the way over to the right. So you'll see the PEs, which is a PE or free cash flow yields for each one of the funds and what that represents. And so a lower PE means that the price is cheaper and the growth expectation is lower. You take a look at the growth rates, these are growth rates expected going forward. And Bonhoeffer is slightly lower than International, but it has a PE of about half. And then again, if you look at the MSCI, the multiple is 18, but the growth rate is not that much higher. There are some quantitative ways that people have looked at this, and so clearly the portfolio that we have has some advantages from that perspective. Some of the other aspects that of the characteristics I think that are important for investors to realize is the debt to EBITDA on a weighted average basis is roughly 2.5 times, which given this low interest rate environment is very, very modest. The interest coverage is relatively high at 12 times, which is, is really good in terms of these businesses. So they're able to borrow at really low rates and don't have a whole lot of debt from that perspective. Our weighted average upside, this is basically sort of our expectations taking a look, let's say, at a normalized growth rate, long-term growth rate of these companies, is roughly around 200% from the current valuation. You can sort of see that in the multiples difference between the two if stuff just sort of normalizes. You still would expect a premium on some of these other ones, but maybe not quite as much. And then one of the other big things is you can see the size differences. We're much smaller than these other companies. A lot of these businesses are smaller, but they seem to still generate good returns on invested capital and do things in maybe more niche areas that some of the larger competitors really aren't doing it from that perspective. Those are some of the, I think, important portfolio characteristics for you as an investor to really understand of the companies that you're holding. You are an investor in the Bonhoeffer. Over the next 3 slides, we're going to be describing specifically our frameworks that we use in the Bonhoeffer Fund to look at and examine various value opportunities that are in the marketplace. The first framework is described as compound mispricings. These are situations where both the firm is mispriced, in other words, is undervalued, and the security and the capital structure of the firm also is a relatively low value, and therefore by melding the two together or investing in this sort of derivative security, you actually can get some really nice gains because there's 2 ways to win, or there's multiple ways to win in this case. One way to win is the market recognizes the company is undervalued and it goes up. And the second way for you to win in this case would be the discount of, let's say, a non-voting discount just declines as a result of better governance, for example. And so you can really get these gains. And as a result of this, these gains are not additive, they're multiplicative. So if you're selling at a 50% discount to intrinsic value and you buy, let's say, a non-voting share of a company that's selling an additional 50% of value, if all of those approach fair value, you get almost, let's say it's 50% of value, you get almost a 4x return. So these can be really good situations. And again, they're sort of found in different types of things around the world. Another aspect of both the governance and the valuation aspects is they can be loosely correlated with each other, so you get a little bit of diversification in sort of the value realization of these situations. And again, sort of the governance is important, as we had mentioned, in growth in terms of realizing value here, but the underlying growth that we've sort of emphasizing throughout the presentation also is important in terms of reflecting on what the growth's causing the growth and is that growth sustainable. I think that's part of the key in terms of looking at the drivers is you want to find sustainable growth as opposed to one time. We had talked about gains are multiplicative. One good example of this is basically long-term call options. There's these securities called LEAPs, which are long-term call options. And so if you buy a long-term call option, it can be undervalued from a number of situations. The first one being that, let's say, the security is undervalued. But second of all, just the way the options are priced are based upon volatility and a lot of other parameters that go into the Black-Scholes model. However, for some of these situations, it's really tough to sort of get an estimate of that. So the call option can be mispriced as well as the underlying security can be mispriced. And this was something that was mentioned by Joel Greenblatt in his book, You Can Be a Stock Market Genius. And this can also be applied in other situations like we've seen in Korea and in Italy. Those are probably two specific areas in the portfolio now that have these type of compound mispricing situations that you actually are holding as being a shareholder of the Bonhoeffer Fund. The next framework we'll be discussing is characterized firms or countries. This is another sort of characteristic that we look for in our businesses or countries that we invest in the Bonhoeffer Fund. These are situations where a firm is valued by the market as one type of firm, let's say in one industry, but it's actually the firm is basically competing in another part of an industry or may have a larger total addressable market than actually originally is contemplated. For example, an example that most people may be familiar with is Amazon. Amazon, when it first came out, if you looked at it just as an online bookseller, basically you would say that the price would have been overvalued a long time ago. But they had a much larger market that they could apply this technology to. And so it was really being mischaracterized as basically just being in one segment or niche. There's other companies that have similar types of larger TAM characteristics like Uber and Lyft, the same sort of thing. Is do they just replace taxis or they have a much larger TAM, total addressable market? And I think the market has recognized that they have a larger market and therefore their prices have gone up accordingly. An example in our portfolio of this kind of situation is a company that on the surface looks like a shipping company, but in essence, they actually provide services and they do have a shareholder position in one shipping business, but it's much more of a service business that has a lot of recurring revenue. That's Wilhelm Wilhelmsen. It also has a great management team and actually has been one of the few shipping companies, given that it's service oriented, that's actually grown since the year 2000. That's an example of mischaracterized firms, and we have a number of those in our portfolio. At the end of each of the descriptions of these types of characteristics, we'll sort of show a chart that sort of shows in the portfolio what percentage of the firms have these various characteristics. And again, as a shareholder of the bondholder fund, you're getting all these as part of the package that you're getting. The final of the three frameworks that we use is private LBOs in special situations, including hidden options. These are basically situations where you get a stable company that has a lot of, let's say, recurring revenue. They can make good returns on their assets and they're going to utilize a decent amount of debt or an applicable amount of debt. I mean, John Malone is the master at this with cable companies. Cable companies have very highly recurring revenue streams that can be levered up to make decent returns on a levered basis. The thing that helps these companies is the free cash. What can actually happen here is as the debt is paid down, the company becomes a better credit and they can lower interest rates. So you can get a pretty good virtuous cycle. Some of these companies have also been able to do synergistic acquisitions where you can really realize cost synergies, and that can really add a lot of value to the bottom line. This is sort of like what was done with Cap Cities ABC. In addition, there's been some academic work that's talked a little bit about these private LBO businesses. Dan Rasmussen has put together a paper that describes private equity and how private equity has sort of over time really gone to hire multiple companies. But he has mentioned that there's a possibility of investing in public companies to get the same type of result. Maybe investing in companies that have lower EV, enterprise value to cash flow basis, which is similar to the stuff that we invest in, and actually put some leverage on it. Another interesting example of this is Warren Buffett's recent purchase of trading companies in Japan, very solid businesses, recurring revenues, but then borrowing at a really low rate to buy these businesses. Another example of sort of this spread trade, which I think can be very powerful as long as you have a good recurring revenue base to lever up. Other situations, special situations that these include, and we'll talk about a specific case, there's holding company transactions that happen in Korea, which create some really interesting situations in which we've been able to take advantage of over the years. In terms of unlocking value there, a specific example of sort of a public LBO is XM Sirius, which John Malone basically got a stake of, and then over time has levered up. It's got a very high recurring revenue rate, and then being able to basically use the cash flows of the business, the growing cash flows of the business, to reduce the debt. This can also be seen in other situations where you have actually some software companies and some of the software private equity firms have done this on a very successful basis going forward. And the fact that if you have a growing business, in essence, you can lever it up. That's probably the best of both worlds. Leverage really becomes in danger when you have a shrinking business. And so the key behind it is trying to find a growing business and levering it up with given especially the market rates today. I think that's part of the reason why Buffett did it is the market rates are so low that in essence, can be an arbitrage that can be very profitable if you underwrite the asset side of this trade. The final illustration in this section of the presentation describes how the frameworks are represented in the portfolio. As you can see in the chart below, they're quite widely represented. And the reason why the numbers don't add up to 100% is that in many cases, we have two and sometimes three of these different frameworks present in the security that we're investing in. This provides diversification in terms of potential events unlocking value. It also provides some interesting opportunities, and as we had mentioned before in the compound mispricing cases, can actually be multiplicative in terms of versus additive. And the public LBO area is especially, I think, attractive today given the low cost of borrowing and the ability to lever up recurring revenue cash flows. Hidden options, another aspect, those are basically situations where there is right now, there's no cash flow from the business, but it's sort of like a free opportunity to enter a new market. And we do have some of those in our portfolio. They're not quite as numerous as the other characteristics we described previously. The next part of this presentation is going to describe lessons learned that I've had primarily over the last 12 months and some of the analysis we've performed on the portfolio in reaction to changes in the marketplace and reactions to the market valuing inappropriately, and in some cases appropriately so, some of these higher growth companies and taking a look at our businesses in context of that. And so the first thing that we looked at was disruption. We looked at that in the spring, maybe a little before that through the fall of last year to ensure that our companies, that if they were in a potential situation where disruption could occur, that they either mute it so that it wouldn't affect their business for a number of years or had other ways to counter the disruption. In each one of the cases, that turned out to be the case of the companies that we hold. The other thing that we've looked at has been sort of revenue growth, sort of taking a look at what are the drivers behind that growth, understanding things like velocity and recurring revenue and trying to look for those in our businesses and taking a look at what can really happen. Also, another thing we can look at some of the businesses, especially some of the telecom businesses, are there potential total addressable markets that they can start to become a part of. I know for example, in Korea with KT Corp, they've heavily gotten into video and cable. And so in essence, it's becoming a quad, what they call a quad business, which is basically providing all the telecom services. They've set up an exclusive agreement with Netflix and other types of content providers. So there's some very interesting things going on there. The other aspect that we've looked at has been velocity. Now, velocity in my mind, is sort of matching customer with product. So in the simplest form, you can think of like a retailer that has a product, and the quicker they can match it, let's say like in an auto retailer, the quicker that the retailer can basically match the customer to the product, that results in faster turnover. And so the businesses that we've liked to invest in have had relatively high turnover. And what that allows the businesses to do is with the same margin of, let's say, their competitors, they could actually make a higher return on invested capital. Or what I've seen some of them do is if they have a much higher turnover, then they can actually charge lower prices, provide the consumer a better bargain, and still do better than their competitors on a return on invested capital basis. And these businesses have local economies of scale, which can be taken advantage of also. And so those in combination is what we've really seen in a lot of these distribution/local auto dealers. One of the key metrics we look at there is sort of inventory turns for those types of businesses. Again, we talked about basically the core philosophy of Bonhoeffer is going to remain the same because we feel that it's a philosophy that basically will generate growth in value over time. And what we've looked at in both the existing and new holdings are some other aspects of growth, looking at things like economies of scale, recurring revenue, and or velocity. And some of the things that we look at for any future consumer names, at this point we have a few of them, but not a whole lot, is sort of customer satisfaction metrics, et cetera, as being another sort of coincident indicator with inventory turns and other types of situations. And we're actually going to give an example of that, of velocity, as one of the examples at the end of the presentation as a case study. So this is the first of our two case studies that we're going to be presenting in regards to various situations and how these frameworks have played out in reality. The first situation is a company called Tae-Young Engineering and Construction. It's basically a Korean company that has a combination of construction, sewage, and media businesses. It sounds pretty disparate, but that's typical in Korea. You have companies that have lots of different unrelated types of businesses, and that's one of the reasons I'm so excited about Korea in terms of spin-offs, is this is not unusual in Korea, and over time I think there's going to be more and more of these types of situations. In this particular case, there was what was described as a holding company transaction is happening. In these transactions, what happens is typically in these businesses, they own minority interests of other operating businesses. So a Chibo will have a series of subsidiaries in various businesses, and there'll be a lot of cross holdings. What this transaction allows is an aggregation of all the minority interests into one holding company. And then what the family can do is they can sell holding company shares to pay the relatively high estate tax in Korea. This allows them to retain control of the operational businesses without actually, they can pay the estate tax without losing control. The offset is there's certain rules that the government has set up, good governance rules and other types of things to basically incentivize the companies to do the right thing. This is an example of one of the reasons why I really like Korea, in that the government is using smart policies to encourage companies to do the right thing, which is sort of the case what happens in these holdco transactions. Now, specifically what happened here is we were holders of the preferred shares. So as a result of the transactions, we would get preferred securities in both the new spun off opco and the new holdco. And this there was a previous situation where the same thing happened about a year or two ago with a company called Latte Chilsung, and this one, we've done it with this one also. The preferred common discount sort of numbers on these can be relatively large. Now, what we did, the other thing that added some real excitement about this one is there was an activist involved in this for the previous year or so. A company called Must had been involved in sort of pushing this. So there was really a catalyst that could be identified here in terms of something really happening to unlock value. Historically, this discount has been relatively large at 75%. This was one of our original holdings in the portfolio. We sold it shortly after the preferred had doubled, and sold it a very large premium to the common. And then we bought it and sold it. I had done this in my personal portfolio probably in 2015. So this is the third time where we've sort of been able to take advantage of this kind of situation with the preferreds and the common. So what we did here is we purchased the preferreds in June of this year. It still had a relatively large discount, roughly 70%. And the common at that point was, as far as I could tell, traded pretty close to fair value. I think the price may have gone up since then because they've been able to sell their sewage business, and there's been a number of bidders on that, and so the price has probably gone up a little bit since then. But what actually caused the gap to close, resulting in our portfolio getting 166% gain, was the common approach fair value. So you got the 20% discount on the common, and then the preferred discount closed from 70 to 35%. What also I had noticed was Must had sold out part of their position, and therefore we sold this plus combination of the factors going into this, we sold our position too rather than holding through. What happened in our previous holding company transaction is that as soon as the transaction was completed, the holdco value was very highly priced initially coming out of the gate and started falling quite quickly, but we were able to sell our shares as soon as the transaction was complete. We'll sort of see what happens here. We'll keep track of what's going on, and if there are some other interesting situations here, I think it provides some interesting opportunity for redeployment of capital again, and we'll see how this turns out. But for us, for the Bonhoeffer Fund, it's been a very sort of profitable niche of the market. So this is the second case study that we're going to be talking about. This one started still ongoing, but it basically illustrates the concept of velocity and how important that is in sort of growth and the way that we look at businesses. This is in the particular case of a company called Combined Motor Holdings. They're a South African car dealer. They provide new car used sales, service, and leasing. There's three major players in the South African market. There's Modus, Supergroup, and CMH. Historically, this company has had done really well in terms of growth and underlying business revenues and EBITDA. These car dealerships have lots of local economies of scale, and if you look at CMH's footprint, most of their dealerships are within the three largest cities in South Africa, so they do get quite a lot of operational synergies or leverage from that perspective, and so in economies of scale. So the one thing that's interesting about this business is their inventory turns is highest amongst other two dealers, which are much larger than them. So they turn cars at roughly 7.5 times, which is a very, very high for a standalone dealership. In my mind, this is basically saying that the dealer is doing a really good job of matching customer to car, which is what car dealership sales is all about. And then, you can take a look at them versus the other South African competitors have 3.5 to 5.6 to give you some other benchmarks. I mean, the US ones are probably like four to 5 times. I mean, best on CarMax type one is probably around 5 times, and you can get, there are CarMax and Motorpoint in the UK, which have higher ones also. So their turns are comparable in terms of it being 7.5. CarMax and Motorpoint have similar types of them, but they're a much more specialized business. So these turns is really important concept. There's actually a company in China called China Dong, probably from what I can see, one of the best auto dealers in the world in regards to turnover. And the CEO basically writes an annual letter, and it's the only one I've seen that really brings up this idea of inventory turnover, which I think is very important in the business. But he's really the only one that I think is extensively focused on that, and he's done relatively good. I mean, the returns, the turns in that place are just incredible. Now, in terms of margins, their margins are higher than Supergroup, but they're lower than Modus. But the combinations, I mean, the math behind this is it's margin times turns equals return on capital. And so if you do the math, you can see that they have really high returns on capital and can do that as long as the turns can be there. And the nice thing about it is that that's sort of what they sort of have that sort of set up in terms of the math of the situation at this point historically. Now, what's happened with the stock? The stock has really got hit overall with the overall South African market. It's declined about 50% versus the same for Modus, but Modus again has lower margins and lower turns, and 28% for Supergroup. Supergroup's a little bit more diversified. They have dealerships and other types of stuff that they do outside of just but they have dealerships in Australia and the UK in addition to South Africa, and then they have other distribution businesses. So what was really interesting about this is that they have better turns and margins, so much better business, but the decline is similar for them as it is for Modus. Again, the overall South African market's down 22%. Again, this business, I think it's very interesting in the situation that's in right now. Now to give some context of what a rebound could be like after COVID. Now in South Africa, the COVID's going to probably have a longer lasting effect than in the US and other places. But just to give you an idea of what can happen afterwards, the China Midong basically is based in China, and they're up 171% per year. They're, of course, the premier brand in China, but that gives you some idea of what the rebound can really do. Most U.S. companies have rebounded to probably at least January 1st prices. Most of the UK dealers are down about 20%. And again, South Africa may be a little bit of a lagger, but I think overall the same story can play out there. And if that's the case, the valuation of this company is relatively cheap, and given the turns and the high return on equity, it just seems to be an out of place kind of security, and it seems to basically be priced as though the company was going to go out of business, which clearly, given the economics of this, isn't the case. So that's the final case study. Really appreciate your interest in the Bonhoeffer Fund. And again, feel free to reach out to me or to any of our team if you're interested in the fund. Also, if you want to discuss any of the investments, it's basically your fund, it's your money, and I'm willing to discuss the philosophy and the way that your money is being invested. So again, thanks a lot, and wish your family safety through this COVID time, and hope to talk with you one-on-one and the one-on-ones we've set up after this presentation. Thanks a lot. Bye-bye.